when we talk about putting money into a whole life policy, the biggest functional feature is the fact that you're going to be able to beat inflation long term without giving up liquidity of the large part of your money. Now, I'm a big believer we all need to have money kind of stashed aside for emergency, for that rainy day fund. We need to have money positioned to be an opportunity fund and be an opportunistic investor kind of profile. I think that's a big deal. And when we look at like our options, I guess, as far as where we can keep our money, a properly designed whole life insurance contract is the best way. And now here's the cool part. Hey, what's going on, cash flow hackers? It's Chris with Life 180. And for this video, I want to talk to you about why it makes sense to save your money inside of a life insurance contract. Now, properly designed whole life insurance contract to be specific. Now, here's the bottom line. When we talk about putting money into a whole life policy, the biggest functional feature is the fact that you're going to be able to beat inflation long term without giving up liquidity of the large part of your money. Now, I'm a big believer we all need to have money kind of stashed aside for emergency, for that rainy day fund. We need to have money positioned to be an opportunity fund and be an opportunistic investor kind of profile. I think that's a big deal. And when we look at like our options, I guess, as far as where we can keep our money, a properly designed whole life insurance contract is the best way. And now here's the cool part. So I thought it would be really fun to really dive into why I think this. Now check this out. I'm going to zoom this in here. Hopefully you can check this out. So when you put your money into a properly designed whole life insurance policy with a participating mutually held life insurance company, basically what you're doing with that company is you're saying, I'm giving you, life insurance company, permission to manage my money for me. Now, when you put that money into your policy, it doesn't really just sit inside of your policy. It goes into the general fund of the life insurance company. And then they put your money to work with the billions of dollars that they have and that they manage. And you can see, basically, you get professional money management for people who typically can't afford professional money management at that time. So you can see here what they do as far as allocation goes. Literally, check this out. So the bonds right here, 53.6% are going into bonds, 12.2% are going into mortgage loans, 10.8% are derivatives, 8.9% are in common and preferred stock, 7.1% is going into policy loans. Now, I want to talk about this for 1 second. So policy loans, remember, you're never borrowing from your policy, you're borrowing against your policy. And as the policy holder, you are participating in the profit of the life insurance company's general fund. That general fund performance is impacted by the policy loan. So if there's a policy loan getting 5% and you're paying 5%, you're actually contributing right here to the overall general fund performance. That money is set aside, and when you borrow against your policy, there's a pile of money sitting in the general fund that's allocated to be lent out in policy loans. That is how this works. Now, they got another 4.4% in partnerships and LLCs, 2.8% sitting in cash, and about 0.2% sitting in real estate. So this is, when you put your money inside of your whole life policy, this is the diversification that you're getting. And this is one of the reasons that, like I said, if you look at these, a lot of these things are not super sexy. They're things that are great hedges. The correlated movement of these things is very diverse in a lot of ways. And so if there's a downswing in the bonds, some of the derivatives are going to pick it up, and they've got this balanced up. So it's going to get you the best return possible without taking on a lot of risk. And that's why I always say life insurance companies are the best managers of money in the world when it comes to mitigating risk and preserving the purchasing power of your dollar. And that is what they are doing here. Now, what I want to do now is I want to go to the next slide and take this conversation to the next level. Look at the market returns in dividend interest rates before expenses and taxes with life insurance companies, with whole life insurance companies. So you can see here, when we talk about where are we going to keep our safe money and keep liquidity use and control of that money. Now, we can put our money in bond index funds, right here, which is this column right here. Or, there's the stock market index, but there's a lot of variance there. You can see here the standard deviation right here. That's basically talks about the variance involved in the account. So while the stock index, is pretty good, the variance in those accounts, the standard deviation is off the charts. You can do a 50-50 blend. Once again, still a pretty high standard deviation. And if you want that safe, guaranteed, liquid, accessible capital, that's not the best place to put it. Now, so let's just X these off and let's just talk about a bond fund versus a life insurance policy. And when you look at the two and you compare them, check this out. The return, the average return from 1980 to 2021 inside of a whole life policy is 8.4%. That's the guarantees with the dividends added on top of it, 8.4%. This is historical factual data. Now, I'm not going to sit here and blow smoke at you. You're not going to get 8.4% this year. The rates have been much, much lower in the past decade. And so these general fund rates have come down. But this is a big reason I'm a big fan of whole life right now, because as we've seen in the markets, interest rates are going up. And we just kind of came through, or we're going through kind of a late 70s kind of environment where inflation is kind of high. The market is just super volatile and uncertain. And so what are we doing? We're going to have to jack rates up to control that. And we're going to have a situation very similar to the 80s. And that was the best decade that whole life has ever seen. I think we're going to repeat the 1980s again. And so I think we're going to be coming back to this. That's why when I look at whole life illustrations, there's no guarantees and there's no crystal ball. But I do believe with a lot of confidence that whole life policies are actually going to outperform their illustrations, and that is the reason why. Now, when we compare this to a bond index, check this out. The bond index average is actually less. It's 7.5% compared to the 8.4%, so it's 0.9% less. But here's the deal. Standard deviation is 6.7 with 1.7% for whole life insurance, meaning it is very predictable, very consistent. The smallest year that whole life had is 6%. And when you look at this, the worst year for the bond index is negative 2.9. Now, I'm going to say this worse, that 2022 is going to be the worst year that these bond indexes have seen. They are getting absolutely eviscerated right now. And so you got to be on the lookout for that. All right, so this is the Callan periodic table of investment returns. Now you can see here, these 3 years, 3 out of the last 14 years, whole life insurance would have been the best performing asset in your portfolio. This is looking at global U.S. fixed income, U.S. fixed income, global and U.S. fixed, I should say, U.S. fixed income in general, real estate, cash equivalent, meaning just holding money in cash or the equivalent, high yield investments, emerging market, developing equity funds, small cap, and then large cap, right? And so you can see here that fixed does really well when large cap and small equities, when they struggle. Now, sometimes real estate does really well as well. Now, what I do want to say here is I'm gonna just clear this out for a second. So what I do want to show here, which is really fascinating, this is why I love cash flow hacking so much, is because, so I want to take a second here and go through U.S. fixed income and see how it does really well, when it does really well, and when it does bad. So fixed income, U.S. fixed income doing poor. U.S. fixed income, you can see it's doing really bad. Now, what's going on? Why is it doing bad? It's not that it's doing bad. It's 4%, 3%, 4%, 1%. This is during the boom years when things are going absolutely insane. So, you don't want to have all your money, getting crushed there. But look at this. So U.S. fixed income, but then 2008 comes and it does really well when everything is losing, right? The next year it doesn't do so hot. Check this out. Then 2011, it's really good again. U.S. fixed income, I'll just get through this real quick. Check this out. So, and you're going to see in a second why this is so cool, right? So, all right, so here we go, U.S. fixed income. Okay, so all those red circles, those are all the years where the U.S. fixed income kind of sat, or where it settled, how it performed. What I love about this is real estate is got a kind of an inverse movement to the U.S. fixed income. And so by having your money in whole life insurance, while in 2008, once again, 2015 and 2018, whole life insurance would have been your best performing asset in your portfolio, hands down, you still have areas in other years where it would be really competitive. And when you combine real estate as your strategy and you utilize the cash flow hacking methodology and you utilize whole life insurance as a storage vehicle for your capital, you can always be able to take advantage of all the different market segments and flows of things. Because you can see here, real estate did awesome. So when your money's down here, right, in 2003 here, when your money's down here, and if the market's going to get good, you could borrow against that money and you leverage it out and you get your big returns. You get your big returns. You can see all the years it's bad. You don't want to be parking your money here. But the great part is you can never lose. So in years where the market starts to go bad, real estate in 2007 and then 2008, real estate did horribly again. You can see the fixed income is doing better. So you always have the ability to kind of ebb and flow with the market, right? And you can see this inverse relationship, and that's why this is so powerful, such a powerful strategy, right? Like you could see this. Very rarely do both, if ever, correlate in the same thing here. And I'm just kind of doing this on the fly because I know this and I saw this chart and I just had to show it to you. So you can see here, real estate did really poorly in 2020, but that's a really small, I think we all know that that's kind of a little segment because of the way that they did the times, because in 2020 and 2021, the market wound up booming because of COVID. But I think this was like early, maybe, I don't know what the dates are as far as when they're pulling their numbers and stuff. But when we look at this, if you think about this, like this is the power of combining whole life insurance with real estate, cash flow real estate specifically as an investment. Now, if you want to go do the other things, this is what I could say. I mean, obviously, if you want to do large cap equity, small cap, emerging markets, any of that stuff, I'm not saying any of that is bad, but the bottom line is I can show you very, very, very factually on this map. I could do this with every single one of the investments that anybody would really want to take a risk in to be able to get the returns that they wanted. And I could show you how utilizing whole life insurance as a storage vehicle for your capital to leverage to put into those higher risk investments when it was time would be the way to go. So anyway, I hope that makes sense. If you have any questions, comment in the comment section below. Happy to answer, engage with any questions that you have. If you haven't already, make sure you subscribe to the channel. Hit that bell, that way you get notified every time I launch a new video. Till next video, have a blessed, inspirational day. We'll see you tomorrow. Take care.